Let's make sure relentless asset management, relentless asset manager, RAM God. Let's get it, man. Let's just get right into it. Now, we can go ahead and just take a quick outer look, right? We're on the weekly time frame, just looking at the price. You know what I'm saying? We're just looking at price. Knowing there's a lot of bullish pressure going right now, running into some major lower highs here. Beautiful. Still a good amount of pips away. Beautiful. Let's just go to the daily. We're just eyeing things right now. We're just taking ganders right now. Obviously this downward structure has now shifted to a slightly nice upward structure, continuous higher highs, higher lows, as we have discussed already. Zooming in just a little bit on this candlestick structure, what I want to highlight as of now, especially since we have a few lines here, is specifically understanding that for right now, we see the daily close with potential daily wick fill again, just like yesterday. So this was yesterday with the bullish candle with the wick left. The thinking was, shit, man, Asian session created a low and started to come back, filling the wick, boom, fill the wick, made a new high. So respectfully, a similar thing could happen, even if this daily candle wants to be uh, bearish or even potentially a low volume candle. This can simply just retest this high. Now, at the end of the day, the cool thing to notice with this volume and when gold is from the close to the open is 100 pips, and that's beautiful. So at that point, that's just something to think about. If we can get some bullish price action to fill the daily wick, um, and shit, whatever it wants to do, we'll do. We'll keep the principles the same as of buying low at supports and retracements and selling high, specifically at resistances. So if it does move up and makes a high or tests a high, I'm not thinking buys until it's broken. But if it does come down and create a support, I'll always be thinking buy. So keeping those principles kind of similar, looking for our structural levels. At this point, we're on our 4 hour. We're not doing a deep technical analysis right now, by the way. This is just a couple things that I see. You know what I mean? Just a few things that I see. I'm just marking them out. I'm going to delete a few of these things here. But yeah, I mean, shit, you had previous daily high. I'm going to just place that there. It can get adjusted later. Daily close, daily wick, Fillington, and things like that. Now that we're on the 4 hour, you can see that this resistance was broken and retested as support. This is the line that marks the daily wick Fillington level to go back up here. And obviously that's the high. So, I mean, we have a nice support here. That's where that highlight comes from. We have a very nice support right there. Now, I'm going to delete this for right now. Again, not doing a deep technical, but I'm going to change it to more of a horizontal rate just so I understand that's more of a situational type thing than it is anything else. Put that right there. Right. Right. So anything above here is basically daily wick Fillington. Anything below here is current daily low. And this is the open of the day. So this is like daily low action, retest the support, make a daily low wick, go back up here, retest that. It's beautiful. Beautiful trades, beautiful opportunities already. You can see him. Shit, you even have a nice 1 hour order block type situation here. Very nice. Very nice. Very nice. But I told myself yesterday, one of the main things that I wanted to do today in this session was to read about the meeting minute situation. Now, to my understanding, the meeting minutes is, and I learned about that a little bit deeper today. The meeting minutes, what it is a review of the conversation and the decision. See, it's a detailed record of the FOMC's most recent meeting, providing in-depth insight into the economic and financial conditions that influence their vote on where to set interest rates. You feel me? And so this, they had it already. They had it already. And let's just see what they say. Fed officials see higher rates for some time ahead. FOMC minutes, several officials noted dot plot tracking, notably X, Y, and Z. We're gonna pick one. Minutes of the Federal from the FederalReserve.com. So you see, this is from the FederalReserve.com. This is from CNBC. I think that's where I want to go. I want to go right here. You know what I'm saying? 5 hours ago. Sounds about right. Sounds about right. Let's see where we're at here. Minutes of the boom from FederalReserve.com. Let's just go right here. Let's see if that's the full story. Let's see if that's the full story. I probably got too many tabs open. Oh, okay. It's 12 pages? Oh, shit. All right, let's definitely give it a good skim. So understand what I'm looking at right now is minutes of the Federal Open Market Committee from December 13th and 14th, 2022. Obviously, we have Jerome H. Powell, and let's continue here. Let's just read some, man. Why not? The FOMC is referenced. Okay. Committee. What the hell? Selection of committee. The manager pro tem turn first. Well, yep, let's dive in real quick. All right, starting from this upper paragraph right here, highlighting developments in financial markets and open market operations. The manager pro tem turn first to a discussion of developments in financial markets. Following several months of tightening, financial conditions eased over the period as investors' concerns about global risk edged lower and incoming data showed nascent signs of a moderation in inflationary pressures. Central bank communications signaling a slower pace of policy rate increases appeared to contribute to improved sentiment. Measures of implied volatility across financial markets declined somewhat from the elevated levels observed in October. Consistent with the decline in volatility, model-based measures suggested that a drop in term premiums accounted for much of the decline in treasury yields over the period. Equity markets moved higher. However, equity market contacts noted risk to growth ahead. However, I'm going to just read it again. However, equity market contacts noted risk to growth ahead, and earning expectations for coming quarters had been marked down. In foreign exchange markets, moderating concerns about the potential for highly elevated United States interest rates spurred a depreciation in the foreign exchange value of the dollar. In other market developments, the manager pro tem noted the failure of a prominent crypto asset exchange. While the spillovers from this situation had been significant among other crypto lenders and exchanges, the collapse was not seen as posing broader market risk to the financial system. Regarding the outlook for inflation in the United States, inflation compensation implied by Treasury inflation protected securities declined over the period, responding to a lower than expected consumer price index or CPI data and a sizable drop in oil prices. However, the desk survey based measures of inflation expectations were little changed from the prior survey, suggesting that falling inflation risk premiums may have contributed to the moves. Both market and survey-based measures continue to point to expectations for a moderation of inflation over the coming year. Regarding the outlook for monetary policy, both both market and desk survey based measures indicated expectations for the committee to maintain elevated policy rates through 2023. One more time on that. Key phrase for that would be my fault, indicated expectations for the committee to maintain elevated policy rates through 2023. Elevated, meaning you probably will not see a decline. You may see a small incline, 25 basis point, 50 basis point, and a hold. A non-decrease, a non-increase, simply a hold to let inflation be combated. In the December survey, the median respondents model. I'm sorry. Sometimes in the in the December survey, the median respondents model expectation for the path of the federal funds rate in 2023 shifted higher by 25 basis points relative to the November survey. The survey-based estimate of the expected policy path in 2024 continued to suggest a decline in the target range for the federal funds rate over 2024. Little change from the path anticipated in the November survey. In contrast, the market implied path of the federal funds rate in 2024 shifted down by as much as 3/4 of a percentage point over the period, likely reflecting declining risk premiums. The manager pro tem turned next to a discussion of operations in money markets and assessed that balance sheet runoff was proceeding smoothly. Repurchase agreement repurchase agreement rates firmed modestly relative to the overnight reversed repurchase agreement facility rate over the period, with balance sheet reduction reportedly contributing in part to an increase in the demand for financing of treasury securities. On RRP, balances declined on net as money market funds shifted investments out of the on RRP facility. So I see in recent months, banks continue to increase their use of wholesale funding. Looking ahead to year end, market participants anticipated limited pressures. The manager pro tem noted that if transitory pressures emerge in money markets, the Federal Reserve's backstop facilities are available to support effective policy implementation and smooth market functioning. By a unanimous vote, the committee ratified the desk's domestic transactions over the intermeeting period. There were no intervention operations in foreign currencies for the system's account during the intermeeting period. Now we got staff review of the economic situation. The information available at the time of the December 13-14 meeting suggested that United States real gross domestic product was increasing at a modest pace in the fourth quarter of 2022 after expanding strongly in the third quarter. Labor market conditions eased somewhat over October and November, but remained quite tight. Consumer price inflation, as measured by the 12-month percentage change in the price index for personal consumption expenditures, stepped down in October but continued to be elevated. Total non-farm payroll employment posted solid gains in October and November that were slower than the average monthly pace seen over the earlier part of the year. The unemployment rate moved up 0.2 percentage points to 3.7% in October and remained at that rate in November. On balance, the employment rate for African Americans edged down over those 2 months, while the employment rate for Hispanics increased slightly. The unemployment rates for both groups remained above the national measure. Both the labor force participation rate and the employment to population ratio declined a little over the past 2 months. The private sector job openings rate, as measured by the JOLTS, moved back down in October but remained high. Nominal wage growth continued to be elevated and remained above the pace judged to be consistent with the FOMC's 2% inflation objective. Average hourly earnings rose 5.1% over the 12 months ending in November, close to the pace record in the Employment Cost Index of hourly compensation in the private sector over the 12 months ending in September. Just want to mention my job as a concrete delivery driver. Our company actually gave us whatever you want to call it. You feel me? They gave us an 11% wage increase. I just think that's a good percent. Like, bro, if you're gonna get a wage, I mean, that's pretty cool. Anyway, compensation per hour in the business sector rose 4.0% over the 4 quarters ending in the third quarter, but the reported increase likely understated the true pace of increase of compensation per hour, as the lower second quarter employment data for the quarterly census of employment and wages had not yet been incorporated in the compensation per hour measure. Consumer price inflation remained elevated but had eased in recent months. Total PCE is something personal consumption expenditure, something like that. Price inflation was 6.0% over the 12 months ending in October, 0.3% point below the September figure. Core PCE price inflation, which excludes changes in consumer energy prices and many consumer food prices, was 5.0% over the 12 months ending in October, down 0.2% percentage point from its September reading. The trimmed mean measure of 12-month PCE price inflation constructed by the Federal Reserve Bank of Dallas remained at 4.7% in October. In November, the 12-month percentage in the CPI stepped down to 7.1%, and the core CPI inflation dropped to 6.0%. The CPI, along with the data from the Producer Price Index, PPI, pointed to a further slowing in PCE price inflation in November. A preliminary estimate of the staff's Common Inflation Expectations Index, which combines information from the many indicators of inflation expectations and inflation compensation, edged down in the fourth quarter but continued to be above pre-pandemic levels. Just know, this speech is a freaking mouthful, bro. I'm just let that be known. I don't know if like this was the actual speech or just the notes from it, but damn, if I had to read this shit to a whole damn country, whole damn globe, man, the fuck? After expanding at a moderate pace in the third quarter, real PCE growth appeared to have picked up in the fourth quarter. In contrast, residential investments look to be contracting sharply further, and growth in business fixed investments seem to be slowing markedly, with tepid gains in equipment and intangibles spending and continued decline. The intangible spending and continued declines in non-residential structures investment. Manufacturing production increased only modestly in October, and the available data pointed to a decline in November. A decrease in factory output would be consistent with recent readings from, is this from today? I just want to make sure, like, is the date on this bitch? Meeting minutes of the firm. Was this, I'm assuming this was just about a joint meeting of the firm. Hold on. I spent all that time reading this wrong ass shit. A joint meeting of the FOMC committee and the Board of Governors of the Federal Reserve System was held in the offices of the Board of Governors on Tuesday, December fucking 13th. I need the one that was done today. What the hell? What the hell? What the helium? Bruh. This say bitch say January 4th. It say January 4th. Fast see boom boom boom. Minimum committee. Why'd you put that one there? Hold on. Let me just read this shit one more. Not the whole thing. Let me read this title again. Goddamn title. Like there ain't no damn. I'm gonna whoop your ass if you put it there for no damn reason. I feel that. I. I mean, as I'm reading some of these tweets, obviously, some of these tweets would bring something. I just want to see one other article connected to this situation because it says like here, let me just see this then. CNBC, you know what I'm saying? Full story, give it to me. I think that's what I should have clicked on the first time. Like this one, I don't even know. Yeah, that stays. What's this one? Delete this. All right, so in the CNBC article, title is Fed officials see higher rates for some time ahead. That's interesting. So if higher rates, and like even if they just like maintain them, hmm, we'll see. Is this a video? Hold on. If we got a video, we're tapping in.
I absolutely hate it.
Oh shit.
You get these calluses and these sores. Pick a finger, Which one you gonna hurt today? Once I was able
Hold
to
on.
use Dexcom, I could simply monitor on my phone, and I didn't have to prick. I'm not relying on a finger stick.
The December Fed meeting, Tyler, showed that no Fed members thought it would be appropriate to cut interest rates in 2023. All of them in their forecast for rates raised the path of their funds rate relative to where they were in September. The restrictive stance most officials believe was needed until they were confident inflation was coming back towards their target. Several said that history warned against loosening monetary policy prematurely. Still, Fed officials said they were flexible in setting policy due to the uncertainty of the outlook, and somewhat contradictory, they said they were still data dependent. However, they emphasized that just because they slowed the pace of rate hikes did not mean that their resolve was weakening about fighting inflation. Participants warned against, quote, an unwarranted easing of financial conditions. I'll come back to that in just a second. Now, they did acknowledge in a very small section in these minutes the risk of tightening too much, but they kind of then dismissed that by saying that inflation is the biggest risk to the economy and the one that ought to be addressed. Participants, they cited the possibility that price pressures could remain elevated. Only a couple saw the inflation risk coming back more into balance. The labor market, they said, was very tight. Inflation was unacceptably high. Remember, the context of the meeting is that consumer spending had been pretty high in September and October, as well as financial conditions had eased leading up to the meeting. Finally, just a couple things on the outlook of Fed officials. They say economic activity in 2023 is likely to be well below trend. Of course, they did forecast that half a point increase in GDP, and they said that a below trend economy is going to be needed in order to bring inflation back in the balance. Just two sort of positive or dovish comments that were really not backed up by much, but it did say many participants see housing inflation decelerating and risk to the economic outlook. This is not a positive here. We're weighted to the downside. Kelly?
So I'm just looking at the market. The market, Steve, taking it. I don't want to say dovish, but what do you make of the fact that stocks are a little bit there? Anything you want to add before we move along, Steve?
I think you would make a mistake to take a dovish interpretation of these minutes. They're pretty on the hawkish side, pretty resolved. It's almost like they're tailored to be send a very, very a strong message
Yeah.
about how hawkish and how serious the Fed is on inflation.
Look.
So, hope.
This could be
Whoa.
Detroit style deep dish.
Pause. Whoa. Kill all this noise. Hold on. I just want to make sure my sound was cool. All right, we're gonna listen to that just one more time, but I think it was great to see that they basically broke down the meeting minutes. I know it was in a quick whatchamacallit. We can even take a second to read some of this stuff as well. Get out of there. Um, but I think he put everything that's right here. Pretty sure. I'm pretty sure that's what he shared. So nobody want to listen to this damn thing.
Pizza from Little's.
Oh Jesus, I did it again. All right, so I'm gonna turn this down one more.
Caesars, it certainly has the thickness.
With caramelized crispy cheese edges.
I'm guessing it.
Hold up, we even got some questions. Hold up. All right, I'm about to have to tap in. So we're about to finish out a little bit of this analysis with some of like the fundamentals, kind of getting those ideas in our brain. Then we'll come to those technicals and get some outlooks and things like that, and then we'll go from there. Okay. So,
and given some of the concerns about policy needing to react sooner and more aggressively, what would have been the downsides to cutting rates now? Why not just cut them now? Thank you.
So why not now? And I would say there was not much support for cutting rates now at this meeting. There was, as you see, a number of people wrote down rate cuts, but all of those, but apparently one, felt that that it would be better to see more before moving. And I gave a couple reasons why that is the case. First is just the fact that some of these developments are so recent that we want to see whether they'll sustain. So we felt that it would be better to get a clearer picture of things and that we would in fact learn a lot about these developments in the near term. Ultimately, the question we're going to be asking ourselves is, are these risks going to be continuing to weigh on the outlook? And we will act as needed, including promptly if that's appropriate, and use our tools to sustain the expansion.
Yeah, thank you for doing this, Chairman. Edward Lawrence from Fox Business Network. How do you reconcile the conflicting economic data coming in? On one hand, you have strong overall growth. Consumer spending is strong. On the other hand, manufacturing numbers were a little bit weaker. You have growth in jobs, but coming in a little weaker. And then you have low inflation. And then specifically, what data are you looking at that you decided not to have a rate cut? What in that?
Well, you gave a pretty good picture. I mean, it's a complicated picture, and the answer is we look at all of it. But I would say the big pieces of it are this: the baseline outlook has been a good one, and that has basically been consumer spending coming back up in the second quarter. That is coming true, and consumer spending is at a healthy level, and that makes sense. You've got a tight labor market. You've got companies in surveys saying that labor is scarce. You've got workers in surveys saying that jobs are plentiful. You've got wages going up. You've got high levels of household confidence. So all of that underlying fundamentals for the consumer spending part of the economy, which is 70% of the economy, is quite solid. Job creation, if you take a 3-month average, is still well above the level of entry into the workforce. So that part of the economy is solid. You mentioned manufacturing, and we're seeing this all around the world. Manufacturing, investment, and trade have been weaker, it's not solely a domestic issue, and it may be that there are a range of factors that are contributing to that, including, for example, what China has done over the last couple of years in working to bring down its leverage. Some of it may be uncertainty over your supply chains due to trade developments. The Boeing 737 issues may be contributing in their own way. So their lower oil prices are contributing to lower investment, although they're also leading to lower gas prices.
The December Fed meeting, Tyler, showed that no Fed members thought it would be appropriate to cut interest rates in 2023. All of them in their forecast for rates raised the path of their funds rate relative to where they were in September. The restrictive stance most officials believe was needed until they were confident inflation was coming back towards their target. Several said that history warned against loosening monetary policy prematurely. Still, Fed officials said they were flexible in setting policy due to the uncertainty of the outlook, and somewhat contradictory, they said they were still data dependent. However, they emphasized that just because they slowed the pace of rate hikes did not mean that their resolve was weakening about fighting inflation. Participants warned against, quote, an unwarranted easing of financial conditions. I'll come back to that in just a second. Now, they did acknowledge in a very small section in these minutes the risk of tightening too much, but they kind of then dismissed that by saying that inflation is the biggest risk to the economy and the one that ought to be addressed. Participants, they cited the possibility that price pressures could remain elevated. Only a couple saw the inflation risk coming back more into balance. The labor market, they said, was very tight. Inflation was unacceptably high. Remember, the context of the meeting is that consumer spending had been pretty high in September and October, as well as financial conditions had eased leading up to the meeting. Finally, just a couple things on the outlook of Fed officials. They say economic activity in 2023 is likely to be well below trend. Of course, they did forecast that half-a-point increase in GDP, and they said that a below-trend economy is going to be needed in order to bring inflation back in the balance. Just two sort of positive or dovish comments that were really not backed up by much, but it did say many participants see housing inflation decelerating and risk to the economic outlook. This is not a positive here. We're weighted to the downside. Kelly?
So I'm just looking at the market. The market, Steve, taking it. I don't want to say dovish, but what do you make of the fact that stocks are a little bit there? Anything you want to add before we move along, Steve?
I think you would make a mistake to take a dovish interpretation of these minutes. They're pretty on the hawkish side, pretty resolved. You know, it's almost like they're tailored to be send a very, very strong message about how hawkish and how serious the Fed is on inflation.
All right, and now I'm back. I love that information. I love that information because I also listened to another article today speaking about how, in another video, but article speaking about how freaking they can still see, like an economist can see freaking the price of gold going to an all-time high towards 2024, but also reaching like the 2000s again this year. So I mean, I feel like I could see gold performing as a safe haven against certain economic downturns. So it's like if we know that the economy is needing to have a bit of a slowdown, I feel like at that point, is this loading? I'm gonna delete this shit. if the economy, if the global economy, especially if the U.S. dollar economy is planning on having a bit of a slowdown, if we are going to continue to keep rates high, if we're going to continue to keep rates high throughout the year to combat inflation, which would have a bit of an economic downturn, then gold can still actually, that could be it could be a hedge against that recession. You know what I mean? Because gold was not able to be a hedge against inflation as inflation was rising. Actually, I'll say this: as inflation rose, gold rose. But as soon as interest rates came in, gold saw that downturn, right? But now, if gold continues to have the same rates, my fault, if the U.S. dollar continues to have the same rates throughout 2000, gold futures February 23. What? When was this written? It said 29 minutes ago. So we'll see. But yeah, if the U.S. dollar is able to keep the rates high to continue to combat inflation, at that point, since gold wasn't, it's hard to say gold was not a hedge against inflation, because as soon as inflation rose, that's when gold rose. But as soon as interest rates started to be combated and the U.S. dollar started to gain value because of them, that's when gold fell. But now if the U.S. dollar maintains just small rate hikes and then a pause, but also in the meantime of that experiencing an economic downturn, slight recession type shit, you know what I mean, lower economic data releases type vibe, at that point we could see gold go up based off of the release of the US dollar for temporary month. Yeah, I like that. I like that. So gold near 7-month high as Fed minutes indicate slower rate hikes. Slower rate hikes. And now I feel like I'm starting to understand what that means. You know what I mean? Gold near 7-month high as Fed minutes indicate slower rate hikes. That slower rate hike vibe is going to provide temporary downturn to the US dollar and upturn to gold. Understand, bro, this is 30 minutes ago. I guarantee you gold's probably up right now. This is 30 minutes ago is when this article was written. Boom. Already doing the daily high wick fill. Let's see. Boom. We're in an order block. So obviously these were still gray areas to buy up to this level and then take it through. Let's see how many pips this 30-minute range is. Boom to boom. We're looking at about 25. I'm going to just call it 25. Looking at a 25 pip range. Buys off this candle. Failed to break. Coming back in. Buy. Went up. It really hit the high. You could have took partials there if you really wanted to. It came back. Who knows what you would have did. Probably wouldn't have done nothing. Went all the way back there. Crazy. Let's go back up to the 4. Put this back here. Finish out this. Now let's read this article. Gold prices rose to a near 7-month high on Thursday after the minutes of the Federal Reserve's December meeting showed that policymakers unanimously supported raising interest rates at a slower pace, offering some relief to metal markets battered by rising borrowing costs. Ain't that crazy? The prospect of smaller interest rate hikes by the Fed weighed on the dollar, fueling more bets that the greenback had peaked after a stellar run in 2022, and it is likely to weaken further in the coming months. Come on. U.S. Treasury yields fell sharply after the minutes to a 3-week low. So you're seeing basically these immediate reactions, in my opinion, these immediate reactions are kind of telling you what investors are thinking long term as well. You know what I mean? Because price action is going to do what it does. But we always keep the same philosophy, which is we're going to buy low. So if price is currently sitting at 1855 with potentials to go up to 2000s, then I am aiming specifically next week, as that is the start of our official challenge. But I'm aiming to be able to participate in some of those longer term buys in terms of, hey, bro, I'm actually about to hold this buy volume session at a higher time frame support, lower time frame support, X, Y, and Z. I'm about to hold this probably for like 200 pips. You feel me? With the challenge in my hands, type I passed the challenge. Okay, cool. I've been attacking these moves. Cool. Passed the examination. Hit my profit targets for both. Now that I'm in my profit split month in February, now I'm going crazy. You feel me? Now I can hold these trades and actually earn income on it. So it's like, no, I'm still gonna hold this trade for 200, 250 to that next level, trailing my stop loss decently, very safely, I should say. And then boom, you know what I mean? Go take that, have like 10, 15% weeks just by holding certain trades long enough, and understanding long enough ain't even always that crazy. So having 10, 15% weeks, bro, I'm trying to walk out with like damn near like 40 bands and take like 30 home. You know what I'm saying? Be fucking straight, nigga. Like, nigga, bro, I hit for like 40% off the $50,000 account. Gotta take like, nigga, 30,000, 32,000 or some shit. Take like 32,000, bro. Save that shit. Only takes, you feel me, 1,000 to go get the 100. Go get the 100. Do the same exact thing with these moves. Do the same thing, bro. And then hit for like 40% off the 150 count. You feel me? Which is like 60 bands. You know what I'm saying? Something around there. Because it's what? 10%, 15. So yeah, 15, 15, 30, 30. Man, 60. Take home like 50 bonds. Nigga, after 2 months, and nigga made like, in cash, I got like stacked up like 80,000. Like, stacked. Literally 80,000. Think about that, bro. Think about that. Hit for something crazy in February for like 40%. Take home, like, bro, like, because 20%, bro, look, 20% of the 50 is 10,000. So 20,000, I'll take home like 16,000. Respect, I'll take home like 16,000. Right? Cool. Cool. Then come to the next month, get the account. Now I got, put them together, 150, hit for 40. You feel me? So we're up like 60,000 regardless. We're up like 60 some thousand cash, liquid, 60K. Bro, immediately I'm building a private account. You know what I'm saying? I'm just building an account. That's it. I'm paying off debts and I'm building an account, bro. That's it, bro. I'll keep going to work. I'm building an account though. And now I know why he said we could probably be cool. If that's the case, I probably would be cool too. You know what I'm saying? I ain't gonna cap. I got enough money and enough opportunity right now. 6 months into the year, 5, 6 months into the year. Stacked. With the challenge, do another month. Do another like 40%. I say do that shit like, honestly, respectfully, bro. Do that shit the rest of the year. Really stack something stupid. Do like 40%, 30, 40% a month type shit. Stupid numbers. 30, 40% a month with the 150,000. Be hitting for like 45, 60,000 a month. Take home, bro, by the end of the year, November, December, bro. Try to match that shit. Try to have 150 cash. Pay the taxes and shit. They gonna try to get my ass though. They gonna try to get my ass. All right. The prospect of smaller rate hikes by the Fed weighed on the dollar, fueling more bets that the greenback had peaked after a stellar run in 2022 and is likely to weaken further in the coming months. Nice. U.S. Treasury yields fell sharply after the minutes to a 3-week low. Nice. Still, the Fed minutes also showed that policymakers were hyper-focused on bringing down inflation and are set to keep U.S. interest rates higher for longer. Such a scenario is likely to limit gains in metal markets. I respect that. Spot gold rose slightly to 55 an ounce. It's currently at 56, while Bang 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 reaching the highest level since mid-June. Both instruments logged a strong start to 2023 and are up nearly 2% over the past 2 sessions. Facts, bro. Facts. Bullion prices were also boosted by increased safe haven demand for assets apart from the dollar. See, especially after a warning from the International IMF Fund that the world's largest economies face a potential recession in 2023. See, now gold is going to perform. I'm calling, bro, what is it? January 4th. It's January 4th, 2023. It's looking like gold is going to perform as a safe haven against global economic recession. That's looking like currently the theme right now to start off the year. If there could be a theme, if there's multiple themes, you feel me? Like COVID was a theme, you know what I'm saying? Certain Russia, Ukraine was a theme. Like these are themes, you feel me? Of price action, of driving forces, the fucking interest rates rising because inflation's so high. Theme. You know what I'm saying? So it's looking like to start this motherfucking year off, to start this first quarter off. Oh, hold up. Hello. Had to take a quick call. Boom, 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 boom. Yeah, that's what it's looking like, man. That's what it's looking like. First quarter, first quarter of 2023. The theme for gold, the theme for the U.S. dollar, specifically gold, though, is going to perform as a safe haven against global economic recession, specifically the U.S. dollar. Shit, okay, Great British Pound, motherfucking China, all these niggas. But broader metal markets slipped on the prospect of a global economic slowdown. Among industrial metals, copper prices crept lower and were headed for a third straight day of losses following a dismal start to the new year. But gold looking great though. Copper fell. Uncertainty over an economic reopening in China weighed heavily on the red metal as the world's largest copper importer faces an overwhelming spike in COVID cases. Come on. While copper demand I don't care about no copper. Signs of slowing business activity in other major economies also weighed on industrial metals. U.S. manufacturing activity shrank for a second straight month in December. Data showed on Wednesday today, furthering fears of an economic slowdown in the country. Bro, so as data is being released, so now we're going to come here because we just read a couple articles now. We read a few things. And that kind of took a majority of the time. Not tripping though. We had, so the forecast It came out better than the forecast, just lower than the previous. Understandable. Got it. This one came out lower than the previous and lower than the forecast, just a tad. And I believe that's what they're talking about. So coming into Thursday, economic data. Oh, we got ADP non-farm employment change. That non-farm employment change. Let's see the fuck this time. Actual grade. I mean, they're expecting a larger number, and I guess they said that could be good. More employed people. Job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic. Okay, got it. So if that's up, okay, cool. That makes sense. That does make sense. Consumer. Yep. And then we have unemployment claims, which looks like they're projecting to have an increase. And you know what? We slowed down. My job slowed down during this time. So did you get your workout in? No, I'm about to go there. We slowed down during this time. So that little 5,000 increase, if that's what they're saying or whatever they want to say, 500,000, 5,000, whatever. Yeah, a couple of those was my guys. And then Friday, NFP, man. NFP, unemployment rate, ISM services, PMI, and so on and so forth. And then Sunday, January 8th, it's looking like a quiet day to start out. That's nice. So basically, just so I know, moving into the start of my trading week, just know if I wanted to trade this day, just know I don't have any crazy economic data coming that day. And it's looking like a light economic day until CPI, I'm pretty sure, which is on Wednesday. So people will probably be awaiting that. There could be a slight range created. We don't want to do anything crazy before then. February 1st. Okay, I went way too far. Okay, yeah, way too far. Way too far. So January 4th, cool. We're going to finish out all the things, NFP and all that good stuff. We're going to take the NFP data, the economic data, see how we're rolling into the week, even though we know people, investors and things like that could potentially be waiting on the sidelines for CPI and then go crazy after CPI. High potential on that. But CPI is on Thursday, respectfully. Is it? Yeah. CPI is on Thursday, respectfully. So that there's a few days. So I mean, it could create, a larger, higher time frame, 4-hour range type shit from, Sunday to Wednesday night, and then begin to break out of it. And so I'm already kind of forecasting that as, I mean, we have NFP, but after NFP, I think this is what I'm noticing. After NFP on Friday, right? After NFP on Friday, it's looking like there's no economic data in terms of a heavy hitter until Thursday. So I feel like there could potentially be seen in these 4 days slightly lower volume and quicker moves and things like that in anticipation to find out what's good with these, and then any potential low volume that we saw here, because it's hard to choose a direction when you have this data coming up. You know what I mean? Like, how you going to choose a direction when this data's coming? You feel me? But after that data is released, I feel like now you have kind of clear directions for that. After, I guess, the next day, you have the next day and then the following week where it gets clear again until, honestly, because that's all CAD, until Wednesday. So it's like, from what it's looking like for me, it's looking like potentially the start of next week could be a little slower, which is totally fine. Could have plenty of volume, plenty of clear moves, but it could potentially be slower until CPI. CPI has a breakout, creates new ranges, goes stupid, and then afterwards, based off that extreme volatility, you feel me, maybe has a few other moves after CPI, and then moving into the next week, you feel me, we're looking at some other stuff on Wednesday, which is PPI. We're looking at January 18th. And then at that point, first level should be passed, and now we're moving on to the last level with the last vibes here. And there's plenty of data still to break down the rest of the month, complete that one, and then just move on to February. Cool. Let's go crazy. Let's go crazy, man. All right, now I feel like we've broken down a number of things. Hopefully we didn't get too off track, but let's go ahead and get a nice little quick little analysis going real quick. Let's get the quickie analysis. Just delete everything. Probably gonna put these same things there, but let's keep it clear. All right. Let's just go from the daily. On the daily time frame, easy targets at this daily high. Wick filling time, 100 pips. There's currently no bottom wick at the open. Be aware of that, right? Let's go to the weekly and see what's, oh, nice. See how that made it so easy? That made it super easy. Above here, I would just even go to the candlestick close to start, to be honest. And then go back down to the daily, maybe scrunch that and see what that looks like. Honestly, it looks great. That is clear candlestick range after the break of this high. Again, that is clear candlestick range after the break of this high. Love, 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 you know? And then what we got here, I'm not gonna lie. I know it can run into this, but let me see what that looks like on a lower 4-hour time frame. The fact that, again, it's already in a support and then it runs into this previous resistance, it's love. And we hold that there. And so I already see a candlestick high here on the 4-hour time frame. So if we break there, we're going there. That'll be the next target. We are breaking there. About 29, 30 pips away. Just so happened to be a nice order block situation. 1-hour time frame. Now you see that is damn near almost jumbly. You see that? We're on the 1-hour time frame. Let's go to the 30. Yeah, this is really, obviously we have the structural levels. This is really a motherfucking, just some nastiness. Low, lower high than that, lower low than that, retest, lower high, lower low than that, retest, lower high, lower low than that, retest, lower high, lower low than that. So this is just a whole downtrend range. Structure hasn't really changed too much, and I guess you could say until now. But the cool thing is there's a high potential for this level, potentially, to be respected. Come all the way down here, make a below this level, makes a goddamn daily low, 70 pips, and now you get the chance to take it back up, double bottom, for like, nigga, 150. Damn near have a trade sitting there so lovely. It all makes sense, but I don't like this level. This one's fine, but I feel like I need the level. But I don't like it because it feels like, okay, now the levels are getting too close. That's what it is. I'm going to delete. I'll keep this one. I'll keep that one. I already know what's good with the daily wick fill, so I'm going to go ahead and delete that as well. And let me just look at it like that. And let me just have larger structural opportunities to know, like, this is really what we're kind of looking at. You know what I'm saying? Overall, based off this higher, you know what I'm saying, higher high, support, invalidated, higher low, we're talking about bounce off this support, go there. We're talking about break this resistance, go here. We're talking about bounce this support, come back here. We're talking about break this support if it wanted to. Hey man, we got options. You know, this could happen. Obviously, these ones are more fundamentally sane and induced, especially with the Fed meeting minutes coming into play, knowing that, hey, they're going to keep rates high. That's going to not be so good for the US dollar, X, Y, and Z. Based off all that good stuff, you like, yeah, we're going up. Or it's like, hey, we have gone up a nice amount to start not only the year, but the week, the month, everything. You know what I'm saying? We started this shit from this candlestick right here. We've done 400 points to the top side already. First 2 days, 400 to the top. Wow. You know, like imagine. Really imagine. Imagine you had fucking buys from here. Motherfucking took the first one. Went still red. Then it all did it again. You had buys again from here. Went still bad. You know what I'm saying? And now you got another day and it's like, shit, what you thinking? Buys from here? Still bad. But now you're like, bro, you really just did the same thing. That's like, nigga, what's that like? 16? Held the whole thing. We're talking about 17% 3 times. 3 times in a week. We're talking about 15, 15, 15, 45% in a week, right? That's what you're telling me? Like, yeah, bro. Hit for 15 right here. Like, nigga, hit for 15, 16% here. Did it again here. Did it again here. Called it a week at 45%. Probably just about to, go travel somewhere or something. Man. I just feel like this is a fat ass order block. There's mad pippage in between. There's definitely mad pippage in between. But it's such a fat ass order block though. You know what I mean? Resistance turn support. You know, you got this motherfucker. Like at worst, at absolute worst, I'll put it here where all these damn closes are at. At worst. Just because it makes sense on the 1 hour time frame. You know what I'm saying? That's where the high of this candle is at. 4 hour candle. So since it's a no trade range, if it comes to the top though, it's like I would say don't trade into it. But you could like once it's in and it kind of taps in, if it breaks the top and we can get buys out of support above this resistance, if it comes to the top and starts honestly just denying it, there is potential sales with the proper pattern at this level to come back down. So that's where that comes from. Then you have the same mode if it comes down here, buys, comes back in this range and doesn't even do none of this no trade range shit. Sell, and then below this level, creates a low, comes back, sell at resistance below the support. Go crazy. I bet. So I need a. I'm honestly late. I'm honestly late. I'll be honest. But I gotta go to the gym. I gotta get it in. So I'm about to go to the gym, get right, come back and eat, shower up, prepare my mind with a little spiritual reading, meditation, and go ahead and get on these charts. And if there's still time, maybe even just knock out a little reading in a journal session, but then get on these charts, take some more screenshots. I can always come back to my live stream and take screenshots as well because I have them dated. So that's the most beautiful thing about it. That's the most beautiful thing about it. That's why I like to live stream. Because again, if I don't want to stop and pause during it, but I do want some sort of like, journal or data or, replay, my nigga, just go to the motherfucking live stream, pull up the yet, feel me, pull up these price action patterns and understand I would rather more or less take action here, maybe here, things like that. So it ain't there yet. Let it do whatever it gotta do. Oh, and this would have been